Geoff, good to have you on the program. You've got a deep history in oil. Your dad was an oil man. And I'm curious about the shock absorber effect that you argue we have seen in markets as oil prices have fluctuated over the last few months. Can you explain what has happened here and the way that people or countries are buying?
Sure. When I think about oil and gas, right, the story is kind of two main characters, supply and demand. And so when hostilities broke out in early March, most people focused on the supply disruption in the Strait of Hormuz. All these barrels that were getting to market couldn't get to market. But just as important was on the demand side. And China has increasingly played the role of swing demander, which means that when prices are low in crude oil, they import barrels in excess of their own needs and then stockpile it. And then when prices are high, they import less than they need. And then they destock or they draw on their own stockpiles of crude oil. So what's happened is while most analysts really looked at the supply disruption and projected oil prices to go sort of through the roof, 150, 200, the Chinese on the other side were significantly reducing the amount of imported oil that they took in. So by doing this, think of them as almost like an oil trader where they had a collar on, meaning they were selling an out of the money call and they were selling an out of the money put. And it kind of allowed for sort of a short oil volatility by reducing kind of the swings in oil. They've increasingly been doing this with oil prices for years, but we saw it massively these last few months.
So thank you, China, right, Geoff? I mean, in terms of putting this collar on. But the longer this goes on, at some point, don't they have to restock their reserves? We know that they are all in and increasingly in terms of alternative energy. But if this goes on longer and there's still trouble in the Strait, at some point, are they going to have to perhaps buy and become a bigger factor in the energy markets?
Well, your point is well taken, which is that China, there's always, as you would expect, a lot of opacity with how they make decisions.
Yeah.
You don't even know how much crude they have. That's sort of a state secret in reserves. But for now, we believe they have somewhere on the order of maybe 1.4 billion barrels of reserves. And if you think of the deficit, meaning what they were importing before the hostilities to now, it's roughly 6 million barrels less. So when you take 6 million, over 1.4 billion, it implies they could go a very long time. That doesn't mean they have to. They could go back in the market and drive prices higher today. But I don't think that's their decision. I think that they're truly desire kind of a low volatility for oil. So again, buying more than they need when prices are low and buying less than they need when prices are high.
Geoff, I want to stick with China for a moment because I want to go to them as a country, as a government leaning in big time on alternative energy. And whether it's nuclear plants or what have you, I mean, their longer term play, right, is to get them off of fossil fuels if they can. I mean, they don't like being dependent on others for energy needs.
100%. You nailed it. They view it sort of like the United States did for many, many decades, going back to World War II, right, as a strategic vulnerability to be a huge importer of oil. And as you can imagine, while they're an importer, they kind of rely on the United States Navy, the Blue Water Navy, to protect their supply lines. But on the other hand, if the United States is protecting their supply lines, they could theoretically cut them off. So, China would love to take their need for imported oil to zero. They simply don't have the reserves internally to do it. But they're making every effort to reduce by electric vehicles, because oil is a transportation fuel. They're also moving a lot of their truck fleet to liquefied natural gas, kind of oil-like, but they're trying their best to reduce their dependence on foreign oil.
So Geoff, we've talked a lot about the macro picture, and I'm wondering how this translates into your trading strategy at Energy Group Capital, where you do focus on the energy transition, where you're focused on finding alpha in a market that many people argue is extremely efficient, but has been very volatile over the last few months.
Well, what we try to do just in the macro picture as a fund is we try to identify places where there's supply and demand imbalances that are relatively persistent. So, we tend to so that's one, like when it comes to commodities, where is there too much demand or too little supply, for instance, whether it's oil or gas. We look for places where there's persistent demand. You mentioned solar. We're very bullish on solar in the United States. It makes a lot of sense. You're seeing it in states, not just California, but Texas, where solar is increasingly becoming sort of baseline for the grid. And so we look for pockets of energy where we think that, where we're bullish or bearish on a subsector, if you will. What we try to do within the context of our fund is that we have a risk management overlay. So if we're, say, bullish crude oil, we will have longs and shorts in the sector. And we do that in each and every sector so that we we allow the thesis to play out, but we're not 100% exposed to the commodity price.
I'm curious if you have more longs or long shorts. And I bring that up because we have some headlines crossing the Bloomberg. The U.S. military says it started more Iran strikes today at 3 p.m. Eastern. And at the same time, you've got the U.S. A headline, U.S. backing the Iraq-Syria oil pipeline to weaken Iran's Strait of Hormuz hold. I mean, what's the play here? Like, how do you see this ending ultimately? Does Iran get broken? We know how powerful they are because of the strait. So increasingly, are we seeing the region, the world, try to figure out a workaround, whether it's a pipeline or a different way of longer term moving oil around?
Well, to answer your first question is, we try to stay neutral to the price of oil. So we have relative longs and relative shorts. Because I don't frankly have an edge on the geopolitical. I will tell you that you mentioned 5 years, and 5 years is the right time frame, in my opinion. What's happening now is because 20% of the world's oil flowed through the Strait of Hormuz, and because that was a global vulnerability and it was a regional vulnerability, right, for Kuwait and Bahrain and Saudi Arabia, UAE. What's going to happen is by this geopolitical, let's call it a fiasco, it incentivizes all of those countries to be less dependent on the Strait of Hormuz. So if you think of Iran as having leverage over the Strait of Hormuz, it is entirely temporary, because what will happen is all of the other actors in the region will now start planning around this eventuality. So if you're an Iranian decision maker, you're thinking, okay, if we overpress our leverage here, we're basically expediting our neighbors not using the Strait of Hormuz, big pipelines like we've seen to Yanbu in Saudi Arabia. So my point is that Iran may have some relative leverage today. It will be virtually gone in 5 years. And so their decision making is, what do we do in the meantime? How much do we press today and sort of pull forward the benefits of this leverage?
It just 20 seconds and we got to go? Is it inevitable that these countries will press toward that potential 5-year timeline of moving away from relying on the Strait of Hormuz? Is that just inevitable at this point, regardless of what Iran does right now?
I think it's inevitable. I think that they all found out that they were relying on the kindness of Iran with their drones, of allowing their molecules to pass freely. And so there may or may not be a taxation, kind of a levy going through that, but it's only temporary. They will reduce their leverage.